Good morning, and thank you very much. We meet on a wonderful morning in Washington, and the economy is a little shaky, but still looks pretty awesome. Unemployment 50-year low. This month we entered possibly the longest business expansion in U.S. history. Everything looks great, with one exception, the fiscal picture. It looks terrible. The debt-to-GDP ratio is at a post-war, post-1950s high, and it seems to be headed higher. We're experiencing fiscal deficits that are normally experienced only during recessions. And so the panel this morning is going to sort of challenge, it's going to ask that very sort of like existential question, is this something to worry about? If so, why? And is it something not to worry about? And if not, why not? As the audience may know, there's been a big rethink going on in economics about the dangers of debt. And you are kind of at the center of that debate. You gave a speech, I was there in front of thousands of people at the American Economic Association, where you essentially turned conventional wisdom on its head and said that maybe the terrible things we think about with big debts aren't as terrible as we've come to believe. Can you lay out for us your thesis about why we need to rethink some of these assumptions about debt?
With pleasure. And what led me to choose the topic of a speech I gave at the AA meetings and to focus on this issue was the decrease in interest rates, safe interest rates, since the mid-80s, which continue fairly steadily and has continued, and if we believe markets, is going to continue for a long time. We now have rates which are historically extremely low and even more strikingly lower than the growth rate. And so I realized this was...
In other words, if there's an interest rate of, a growth rate of 4% nominal.
Right, we are basically at 2.5%. Well, if you look 10 years out, 2.1 now, and probably a nominal growth rate of about 4%, right, 3.8. And I realized this was a very unusual environment, and it was worth just revisiting the basic theory of deficits and debt in that context. So it's a fairly academic paper with clearly substantial implications for policy, and that's what I did. And if I were to summarize the two conclusions that I drew from that. The first one is the cost of debt is lower. That's nearly trivial. Both the fiscal cost of debt is lower because you pay lower interest rate, so that debt dynamics are more appealing. That's the first one. So lower cost, fiscal cost, lower economic cost of debt, because the fact that interest rates are so low is a signal, not a perfect signal, that maybe the marginal product of capital is not that high. So although that crowds out capital, which is the usual argument against debt, it may not be very costly if capital is not very productive. So on the first point, the first point is lower cost. The second is this is an environment in which, and that's conceptually different but related, monetary policy has much less room to play. In many countries, monetary policy basically has done everything it can. Interest rates are very close to zero or even negative in some countries, and therefore fiscal policy can do more. So the benefits of fiscal policy in that environment is that it can do something that monetary policy would have done in another context but can't. So there might be larger benefits to using fiscal expansions in that kind of environment. So lower cost, higher benefits. So this was basically the message. Then what I've done since then is basically go around the world and look at the different situations and pontificate about various countries, from Japan to the EU to the US. And each country is different. I mean, Japan clearly is an extreme form of that, has negative nominal rates as the eye can see if you look at the yield curve. Europe is very close also to the minimum. In the US, the situation is not quite as bad. So if I may take a few more minutes to talk about the US, what are the implications of what I've said and thought about for the US? I think you have to distinguish between, say, the relatively short run, say the next 5, 10 years maybe at most, and then the longer run. So in the short run, I think the implication is we have large primary deficits at this point, and the question is, should we reduce them? I think other things equal. If we could reduce them at no cost in terms of output, we should, but the issue is that there is not a whole lot of room, even ignoring the risk of a recession. If we were to have a drastic fiscal consolidation over the next few years, the Fed would probably have to decrease interest rates to offset some of the decrease in demand, and the Fed might find itself again either at the zero lower bound or at a rate that is not very pleasant. I think we all want the Fed to have a bit more margin to play with than being back at zero. So I think the conclusion for the US is, in the absence of a recession, decrease the primary deficit at a rate which does not put into question growth, which basically is a statement about the strength of private demand itself and the ability of the Fed to decrease interest rates. So I think at best it implies a very slow decrease in primary deficits. If there is a recession, my own view, we want to come back to this, the Fed doesn't have the ability to really handle a regular run-of-the-mill recession. And so fiscal policy should be used. In that context, I have no doubt that it has to be used. Yes, it might increase debt, but not a catastrophe. So this is for the next 5, 10 years. For the longer run, I was at the CBO advisory meeting on Friday, and it's clear that there are trends which are extremely worrisome. And if nothing is done in terms of Social Security or Medicare or various other programs, we are on a trajectory of increasing debt. And I can see no reason for wanting this. So it's clear here that my advice is very much the same advice, I think, as the other panel members, which is we have to think now about adjusting for Social Security benefits or contributions, and for Medicare and various other aspects of the budget. We have to start now. I have no desire to see debt increase to 150%.
So just to be clear, you're not saying debt does not matter?
That does matter. The way I've said this, you try to find a sentence which characterizes what you think without people being able to take it one way or the other. I'm not an MMT person. I do not agree with
modern
MMT.
monetary theory, the idea that you can print your
the
way
way
out
I
of
say
any
it
debt.
is debt is bad, but not necessarily catastrophic. I think that captures where I am. Yeah, on the risks, I mean, there are always risks when you have high debt, but the investors will basically get scared and run away. And sudden stops we've seen in many Latin American countries, and I worry about it. So 2 points here. The first one is, how do you decrease these risks? And if you basically embark on a fiscal consolidation, which may have effect on output, and you decrease that from, say, 120 to 118, which implies quite a bit of fiscal consolidation if you do it in a year, it's not going to basically change very much objectively the risks. The others is that even if, what do you do if the investors suddenly wake up, to use the usual expression? And I think here the last country in which this is likely to happen is the US, because there is no fundamental problem, for the moment, there is no fundamental problem of debt sustainability or debt default. The debt service is still low. This is an issue far in the future. And the bond market, the US bond market, will remain the deep liquid market that people want to be in for quite a while. So there are risks, but I'm not sure that they are very large for the US, and I'm not sure that major fiscal consolidation starting now would actually decrease this risk very much. So I think there are 2 parts to it. The emphasis on fiscal policy as being a useful tool, I buy. This doesn't make them unique. I mean, most of us would buy that. The notion that you can finance this by money is wrong. It's plain wrong. And we do it in the US, but what does the Fed do? It basically buys bonds and it issues reserves. Now, that's money, but there's interest on reserves. So in effect, if you consolidate the government between the Treasury and the Fed, it's just a transformation. And basically, what they are doing is issuing debt, right? So in that context, they're not issuing money. If they issued money at 0 rate, right, then we would have hyperinflation. But we're basically issuing a new form of debt, which is bank reserves, which is basically costly to the Treasury and the Fed taken together. So my view is you can do fiscal policy, you can finance it by debt, but the notion that for some magical reasons you can do it through money is wrong. There's one exception to this, which is Japan, which is when you're at 0, debt and money are the same thing. And so you pretend you're issuing money, right? But in effect, it's as if you were issuing debt. The day on which Japan has to basically pay a positive interest rate on bonds, it will have to pay a positive interest rate on the money. Otherwise, people will not hold it, or there'll be hyperinflation. So MMT is right for half and wrong for the other.
So how do we know which half we're going to be in?
If we go back to zero rates, then indeed, in this case, we will be able to finance the deficit through money. And
Okay.
it will be Japan.